Most people think dividend investing is all about finding the highest dividend yield, but that mistake can cost you thousands of dollars over time. Here's the 4-step framework I'm discussing today. Step 1, choosing quality dividend stocks. Step 2, understanding the key dates that determine whether you get paid. Step 3, earn and reinvest your dividends. And step 4, grow your passive income over time. Let's start with step 1, choosing quality stock. When you pick companies with strong fundamentals and a consistent history of paying and growing dividends, you can build an income stream that holds up even when the market gets choppy. This is one way I'm funding my 10 to 1 million investing series with dividends. The pros of dividend investing is dividends are predictable. If a company pays a $1 dividend and you own 1,000 shares, that's an extra $1,000 of passive income for the year. That money is deposited into your account whether the stock price goes up, down, or sideways. Even if the price swings, your dividend payment doesn't. That's what gives you steady, regular cash flow. The second is you may not owe taxes on it, depending on your income. According to the IRS for 2026 tax year, single filers earning under $49,450 and married couples filing jointly earning under $98,900 pays 0% federal taxes on qualified dividends and long-term capital gains. The third pro is historically dividends have made up a huge chunk of total market returns. According to Fidelity, dividends have contributed an average of roughly 40% of the S&P's total return since 1930. Now let's discuss the cons. Well, the first con is dividends aren't guaranteed. They depend on a company's profits. If a business hits a rough patch, say a recession, it can cut or suspend its dividends until things improve. The second is dividends don't necessarily grow the company. Every dollar paid out is a dollar not reinvested into the business. And some argue that money could generate more value long term if it was plowed back into growth instead of handed to shareholders. Now let's talk about what quality actually means when you're picking a stock, because anyone can call a stock quality. So here's how to actually know. First is to figure out the payout ratio. How much of a company's profit is going out the door as dividends? A company earning $1 a share that pays out 50 cents has a 50% payout ratio. Higher equals more going to shareholders. Lower equals more staying in the business for growth. Neither is automatically better, it just depends on the company's stage. Second is dividend yield. Think of it like the interest rate on your investment. If you buy a $100 stock, collect $5 in dividends over the year, that's a $5 yield. Higher yields generally mean more income relative to your investment. But a very high yield can also be a red flag that the market doesn't trust the dividend to last. Now imagine comparing two dividend stocks. One has a 3% dividend yield and the other has a 10% dividend yield. Which one would you choose? Most beginners immediately pick the 10% yield because it sounds like you're getting more income. But sometimes an unusually high dividend yield isn't a bargain. It's a warning sign. The stock price may have fallen because investors believe the company could cut its dividends. That's why it's important to look beyond the yield before making your decision. The third is earnings per share, which means how much profit a company made per share outstanding. For example, if a company made $1 million in profit, divide that by 1 million shares, that means EPS is $1. A higher EPS generally signals a more profitable company, but it's important to pair it with revenue growth and margins before you draw any conclusions. Step number 2, understanding key dates. Imagine you hear a company is paying a dividend this month. So you buy the stock expecting that money to show up in your account. A few weeks later, nothing happens. You miss the dividend investment because you bought after the ex-dividend date. That's why understanding these next 4 dates is so important. The 4 dates are the declaration date, the day that the company's board announces it will pay a dividend and how much. Second is ex-dividend date, the cutoff. If you buy the stock on or after this date, you will not receive the upcoming dividend. You have to own the shares before the ex-dividend date to qualify. Third is record date. The date the company checks its records determine which shareholders are entitled to receive the dividend. Third is payment date. The date the dividend is actually deposited in your account. The most important is the ex-dividend date. That's the date that determines whether you get paid, not when you happen to buy. Step 3, earn and reinvest dividends. This is where compounding actually kicks in. When your dividend hits your account, you have two choices. Take it as cash or reinvest it, usually automatically. Let's say your first dividend is only $7. Most people would think that's not even enough for lunch. But instead of spending it, you reinvest it. That $7 buys more shares. Those shares earn more dividends. Over time, that small amount starts snowballing into something much larger. That snowball is what turns a modest starting amount into a real long-term wealth. It's not the size of any one dividend check. It's the compounding underneath it. Step number 4, grow passive income. Imagine you're retiring soon and your goal is to generate income from your portfolio to help cover your monthly expenses. When comparing dividend stocks, I like to look at 3 things: the regular quarterly dividend payment, the annual dividend yield, and the company's dividend growth over time. Let's compare Apple and AT&T. This data was pulled as of mid-2026. Apple's quarterly dividends is 27 cents a share. Annual dividend yield is 0.33%, and the 5-year dividend growth rate is 4.3%. AT&T has a quarterly dividend of 28 cents a share, annual dividend yield 5.2%, and the 5-year dividend growth rate is approximately negative 7 to 12%, depending on the data source. AT&T reset its dividend lower back in 2022 and has held it flat since. So as this recording, Apple pays you almost nothing in yield, but the company is still growing that payout over time. On top of a business with massive price appreciation potential. AT&T, however, pays you over 15 times the yield right now, but that dividend hasn't grown, and by some measures has actually shrunk over 5 years, with the stock price also underperforming. Picking between the two companies depends on what you're optimizing for: current income or growth compounding over decades. This is the decision every dividend investor has to make for themselves. So, which one would you buy and why? Drop it in the comments below. So that's the full framework. Choose quality stocks or index funds, understand your key dates, earn and reinvest your dividends, and watch your dividends turn into passive income over time. If you want to see this exact framework applied to my real portfolio, including what I bought this month and how close I am to my own investing goals, hit subscribe and follow my journey from investing 10 to 1 million. And to all my current subscribers, thank you. I'll see you in the next video.